Okay, hello everybody. Welcome to Karina Lanta Mentorship. And in this video, we're just going to do another quick velocity banking review. And I'm going to let you all know why I love doing these velocity banking demonstrations, or my favorite part. My favorite part is that we don't have to make more money, and whatever leftover money we have at the end of the month, it dramatically increases just by making one simple change. So if you've never seen these velocity banking demonstration videos, you might be wondering what's the difference between this column, the average American, and this column, because we're going to have the same amount of income, right? So the only difference is what is your main operating account? And so for the average American here, it is the checking account, and for someone who does velocity banking, it is the line of credit. Okay, line of credit. Remember that. So what is velocity banking? All it is a method to quickly pay off debts using your line of credit as your main operating account. And there's only two things that you need. Number one is the budget. Okay, we already have that. We already have that here. And when we do our budget, the most important thing is that we list all of our debts, because when we pay off debt, that's more cash flow, and it's like a cash flow recovery party. Okay? If we don't have any debt, then we don't need this. This is a totally useless strategy if you make $3,000 of income and you have $3,000 of expenses, right? Number two is we're going to have a line of credit as our main operating account, right? And so what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again, right? A credit card is a line of credit. There's also personal lines of credit, home equity lines of credit. In this example, we're going to assume we have access to something called a home equity line of credit, which you may have access to if you do have, or if you do own a home, and we'll just assume that this homeowner has access to both or not access, has access to a home equity line of credit and also a mortgage, right? Well, you don't have access to the mortgage, you got to pay the mortgage, but you get my point. Okay, so when we do velocity banking, we always assume two things, right? Same income, although making more income is fantastic, and zero in savings. Why? Because when we use our line of credit as our main operating account, when our paycheck comes in, we're going to dump it into that line of credit, and it's going to do two things: satisfy the minimum monthly payment, and then lower the interest by lowering that average daily balance. Because when you dump your entire paycheck, that's when that balance is at its lowest, thus lowering your average daily balance. Okay, so now let's go ahead and assume we have a $60,000 home equity line of credit. Think of it kind of like as a credit card, but you can pay anything. You can pay loans, you can pay credit cards. Can't do that with the regular credit card, but you can do that certainly with the home equity line of credit. And here we have a $25,000 balance, okay? So $25,000 balance. And so you might be thinking, what's the difference between this column and this column? You both have a home equity line of credit. The difference is we're going to put your entire paycheck into it, right? So what happens when we put our entire paycheck into that home equity line of credit? This is essentially zero because payment satisfied, right? Payment satisfied. Now we are going to calculate the interest at the end of the month in this column here, so don't worry about that. But we don't have to worry about this payment anymore. And let's just do this, right? Let's move this $26,000 of credit card debt into here, right? So 25 plus 26, that would be $51,000 of debt moved to that line of credit, or in total in the line of credit after moving that credit card debt. And guess what happens here? Zero, zero, bam, bam. So just right off the gate, let's see what happens here. So now we can see a dramatic increase in our expenses without really doing anything. And then if we just calculate our cash flow, take a look at that. I didn't even do anything. It's day one, $900 to $2,251. Oh my goodness. Mind blown, right? I need to hire an editor so I can have those dramatic close-ups and sound effects. But if I move this up, look at that, boom, 900, 2,251 just by day one, by making this my main operating account. And again, if you watch these videos, I just do the same formulas over and over again. In fact, I feel like the internet is just paying me to make the same video over and over again, right? Because it provides so much value to you to be able to do this, and hopefully you'll be able to make these spreadsheets by yourself using Excel, because it's so easy. In fact, let's calculate the next month's balance. right? And so what you do is you take the previous month's balance plus the previous month's interest, and then you subtract your cash flow right here, which is now 2251.63. Okay? 2251.63. Whoopsie. Let me put a minus, not an equals. Okay. All right. So now to calculate the interest, what you do is you get it by the average daily balance. So you get the average of these two numbers. Again, this is an estimate, not going to be exact. Then you multiply it by the interest rate, point times 0.1, right? And then here's the thing. A lot of people are afraid to use credit cards and lines of credit because they see that big 10% interest rate number and they're freaking out like, oh my goodness, I have to pay $4,900 on interest. No, no, no. What you do is you divide by 12, right? Because that's the monthly interest. Okay, so you do have to pay some interest, but here's the thing. As we keep doing this, this number is going to go down, 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 right? Let's go ahead and wait and see how many months it's going to take for us, if we just copy and paste the formula, to get to zero. And as you can see, it took us 26 months. 26 months, right? Look how easy that was. So what we're going to do is put a milestone here and put 26 months to pay off 51K of debt, right? So it's just a little bit over 2 years. 2 years. How many YouTube videos have you seen where that gets hundreds of thousands of views for $10,000 of credit card debt paid off in 10 months? I'm pretty sure I could just do a quick Google search on that. But in 2 months or 2 years, we paid off $51,000 of debt. $51,000 of debt. That's way better than the $10,000 in 10 months videos, right? And here's the thing, my own personal situation, I paid off $58,000 of my mortgage under or in about 1 year. So I think I'm ahead of most of the population. I don't know. I don't want to brag, but I do brag. I'm just kidding. When I say I don't want to brag, that's just me being a humble bragger. But I do want to brag that I paid off $58,000 of my mortgage in about a year. All right. Well, you see, so this is why I love doing this, because what are we doing here? Creating cash flow in an instant without doing anything, right? Just by changing our main operating account, just by switching from a checking account to a line of credit, and bam, we went from $900 to $2,200 in an instant. All right, well, this is Kareem Atlanta Mentorship. If you're interested in joining our group and learning about, want to learn not only how to do these spreadsheets, but learn about financial literacy and real estate investing, go ahead and click the Google form link below. Other than that, have a great day, everybody.